coming up on Retiring Well with Michael Reese.
If you want your retirement to actually work, you got to be looking over here. You got to be looking at these alternatives. Wait a minute. You're not at 100,000, you're at 93,000. What's going on here? Because I told you already earlier, your math was correct.
But somebody close to retirement or in retirement, and they're now relying on this portfolio for income, and it now drops to half its value, devastating.
Retiring Well with Michael Reese, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Michael Reese, where we believe your best is yet to come.
Welcome to Retiring Well. This is your host, Michael Reese. I'm excited about this week's show because we're talking about a topic that, well, we used to hear a lot about this back in the 80s and 90s when markets were soaring. But we hear a lot about it today again, and that is this concept called buy and hold. And the idea behind this concept is you set up a portfolio, an asset allocated portfolio, and then you are done. Your work is done. You've bought the portfolio, now you hold it. And the idea is that over many, many years, there are going to be ups, there are going to be downs, but if you just buy this thing and then go golfing or play tennis or whatever you want to do and forget about it, that at the end of the day, you're going to be in good shape. Well, that might be okay when you're working. But when you're retired, this will definitely get you into trouble. So I have a great story, a great analogy to really help you better understand why that is. So here's what I want you to imagine. So here we go. Imagine that you decide you're going to take a trip to California. You're going to get in a car and you're going to go off to California. You're not going to fly, you're going to drive. Maybe you have an RV, maybe a travel trailer, whatever it is. Maybe you're just going to stop in hotels along the way, but for whatever reason, you're going to drive to California. All right? Now, as you get out of Michigan and you're heading off west, eventually you get into the plain states. And you know what I'm talking about. It's the middle of the country, and it is flat, and there is nothing as far as the eyes can see other than maybe a couple of cows, right? So the road is straight as an arrow. You can see for miles almost. It's a sunny day. There's not a cloud in the sky. Driving, there's no other cars on the road. There's nothing. And the speed limit, let's imagine, is 75 miles an hour. Okay. How fast are you driving? Perfect weather, perfect driving conditions, straight road, flat, nothing in your way. Beautiful, beautiful day. Speed limit 75. How fast are you driving? I don't know. Maybe you're driving 70, 75, 80, whatever it is, right? You're driving whatever your comfort level is. That's great. But now we need to change the story. Because as you're driving down this road, in the distance, you see it out there. It's like, oh wow, look, there's some clouds coming in. Man, it's getting dark out there. And you start to see this storm heading your way. And in fact, before you know it, it is raining cats and dogs. You can barely see 100 feet down the road, it's raining so hard. Well, I got a simple question for you. You still driving 70, 75, 80 miles an hour through that stuff? Or are you maybe easing off on the gas a little bit, maybe slowing down a little bit so that you can be safer? You don't want to get in a car accident. You don't want to get hurt. You don't want to get killed. Are you easing off the gas, maybe not going so fast? I bet you are. And then, or what if, maybe it's not even that. What if the roads start doing these hairpin curves, right? Again, you going 80 miles an hour around a hairpin curve, you're not doing that either. Essentially, what are we talking about? Road conditions change, don't they? Sometimes they're straight, sometimes they curve. Sometimes the weather's nice, sometimes it's not. road conditions change. And when they change, don't you change how you drive? I know you do. I know you do. So here's my question. If you buy and hold, what you're really doing? You're driving 80 miles an hour regardless of what the road conditions are. If it's sunny, you're 80 miles an hour. If it's raining, you're 80 miles an hour. If it's a straight road, you're 80 miles an hour. If it's hairpin turns, you're 80 miles an hour. The bottom line is this. You know when road conditions change, you change how you drive. Well, doesn't it make sense that as economic conditions change, shouldn't you also change how you're managing your money? I mean, I believe my kids would say, Dad, duh, of course you do. Well, that's why buy and hold, it may be okay while you're working, but when you're retired, it can really get you in trouble. It can get you in a crash off the road, and then bad things happen.
Hi, my name is Larry Flynn, and I'm one of the advisors here with Centennial Wealth. Listen, if you're soon to be retired, 5-10 years out, or in retirement, there are some critical concepts that you need to understand in making your retirement vision a reality. Don't be complacent about this. There's so many things that you need to understand, and we're putting a presentation on all across northern Michigan at venues such as this so that we can get in front of you and share some of these things with you, give you some valuable information in hopes that maybe you want to hear a little bit more or go into detail. These are not high-pressured events. We just want to get in front of you, give you some good information, and if there's a chance you might want to meet with us, great. But if not, then at least you've walked away with some valuable information and a gourmet dinner at that. So listen, want to personally invite you to this. Appreciate you coming. Please answer the call on the screen. Thanks.
Hi, I'm here with Larry Flynn. He's one of the advisors at Centennial Wealth Advisory. And Larry, I know you and the other advisors, they do a lot of public discussions, a lot of public seminars on financial matters regarding retirement planning. Can you share with our viewers a little bit more about, what do you talk about, and what kinds of topics can they expect to hear you speak on?
Mike, we put on a 1-hour presentation, and I'll talk about a number of various topics, from taxes to the new fiduciary standard of care, just a number of things that we believe are critical in making somebody's retirement vision a reality.
So this is all about getting them good information in today's world on a variety of retirement topics. That's right. Now, a lot of these events, I know these folks are out there watching us right now. I know what they're thinking. They're thinking, Larry, I've been to these before, and usually it's really nothing more than someone trying to sell me something. Can you maybe respond to people that think about that?
Yeah, I'm really surprised by that. I hear that all the time. Hey, I went to these before. They hard sold me. They were trying to pressure me into making an appointment with them. That's not what we're about. Just want to give them some good information. If they see something from the presentation that they might want to hear more about, then great, we'd love to meet with them. But we're not going to meet with somebody that doesn't want to meet with us. We're not going to hard sell them into having to come to our office.
Yeah, why waste time chasing down people who don't want to talk to you anyway, right? That's right. Well, that sounds great. So, Larry, I know you do these throughout all of northern Michigan. For those folks watching that think, hey, I'd like to attend that. Does it cost anything, by the way?
No cost.
So they're free. So they think, okay, it's free to go. I'd love to go, learn a little bit, maybe have a nice dinner. How do they find out more information, like when these events are and how to register? What do they need to do?
Well, they can call the number they've been seeing on the screen during the program. Okay. They can visit the website, www.sen-wealth.com.
All right.
Yep.
So website, phone number, either way, they can get all the information they need. Is that right?
There you go.
All right, there you go, folks. Sounds to me like it'd be worth your time to attend. You've got nothing to lose. And hey, maybe you'll find out some great information that helps you make your retirement better. Thanks, Larry. This week in Chalk Talk, we are asking the question, what if Jack Bogle is right? Well, you might be asking, well, wait a minute, I'm not real sure who Jack Bogle is and what is he talking about where he might be right. So in CNBC, Jack Bogle, he was interviewed. Jack Bogle, by the way, is the head of Vanguard. He's the guy. Jack Bogle is the guy who built Vanguard. And you know, Vanguard, we've all heard of them. Okay, Jack Bogle's the guy that did that. So that's who he is. Now, here is what he is saying, and we're hearing a lot of really like billionaires saying the same thing. Jack is saying, the headline of this is, Jack Bogle believes, and this came out just in March of 17 here, Jack Bogle believes the stock market will return only 4% per year for the next decade. All right, what does that mean? He says 4%. That's all you're going to earn in stocks over the next 10 years. Well, what if he's right? What does that mean for your retirement planning? Well, let's think about this. Typically, a balanced portfolio has somewhere around half of the money in stocks, maybe 40%, maybe 60%, but somewhere around half, and roughly the other half in bonds or fixed income. Again, it might be 60, it might be 40, give or take. Well, if half the money is over here earning 4, what's the other half the money earning? Well, what are bonds paying? 10-year treasuries are paying 2%. You know, maybe corporates are paying 3. You know, quality, maybe you get some high yield. Probably 3% is a reasonable expectation in bonds for the next 10 years. That's probably what we're looking at. So if you have a portfolio that's roughly half of each, what are you earning for the next, 10 years? Maybe 3.5%, and then minus fees. Now you tell me, how are you going to make your retirement dreams come true on that kind of return? How are you going to do that? What if Jack is correct? And this is what we see. Not just Jack, but you know who else is thinking things like this? Warren Buffett, right? Carl Icahn, Soros. I mean, all the big time money people, they all think this. In fact, a lot of them are thinking this is optimistic. They think that's optimistic. What happens to your retirement if they're right? How do you make your retirement work on 3-4% returns? Well, the answer is you don't make it work on those numbers. So what is the key? How do you get better returns? It all comes, I'm going to write one word right here. Alternatives. Now, more than ever, you've got to open up your portfolio to alternatives. Now, alternatives might be things like gold, real estate. It might be things like covered calls or reinsurance risk. You know what else alternatives might be? Hey, they might be indexed annuities. Annuities that make money when the market's up but don't lose money when the market's down. Or life insurance. There's a lot of different alternatives out there. I mean, they're all over the place, but the key is this. That is not going to cut it. It's not going to cut it. You got to do better. And if you want your retirement dreams to actually work out in an environment where the market's at it's all-time highs, fully priced, fully valued, not a lot of growth, not a lot of room for growth. If you want your retirement to actually work, you got to be looking over here. You got to be looking at these alternatives. You got to have a portfolio that has a lot more alternatives. And heads up, do you know today all the big like institutions, University of Michigan, their endowment funds, University of Texas endowment funds, Harvard, they're 40% in alternatives right now and getting higher. You know why? Because they understand this stuff. You want your retirement to work? You have to be like them. You got to understand it like they do. And that's why you got to come visit with us so we can help you set up your accounts appropriately in today's market environment. I'm sitting here with Larry Flynn. Thanks for being here, Larry.
Thank you, Mike.
He's one of the advisors at Centennial Wealth Advisory. And folks, as you may know by now, we certainly invite you to come visit with us. It's absolutely free to get a second opinion on your retirement planning. And I think it's important to get a second opinion from someone who's a specialist when it comes to retirement planning. And Larry, I'm sure they're wondering, if they pick up the phone and they call and come visit with you, what can they expect? What's that experience like?
Well, Mike, they can expect not to get hard sold, okay? We're going to greet them warmly. We're going to sit down and talk to them a little bit about maybe their story, where they're from, where they grew up, how they met their spouse, what they're dreaming of doing once they get soon to be retired or retired.
Kind of what are their goals, right?
Yeah, what are your goals? We're going to talk to them a little bit about who we are, what we do, show them how we do things, especially dealing in the market realities we find ourselves in today.
Got it. So essentially, they're coming in, you're learning a little bit about what's important to them, what their goals are, what they're trying to accomplish. I'm sure you're taking a look at what they're doing so far. You maybe share a little bit about you, and it's just in a very relaxed atmosphere.
That's right.
And there's no cost to do this. Is that correct?
No cost. No cost.
All right. So, folks, there you go. I mean, it sounds very simple, very easy, very laid back. There's no reason for you not to just pick up the phone, call the number on the screen, come visit us, get that second opinion. You'd be glad that you did. Welcome back. So in this segment, we have an interesting exercise because I find that there's an area where a lot of folks, maybe you're one of them, have some misunderstandings about how money works. And it goes like this. I want you to imagine, for the sake of discussion, that you, in your portfolio, let's say you're averaging 6%. Let's go with that number. Now, you might be averaging more or less, but let's just use that number for the moment. And let's imagine that you come up and you have a bad year in the market. So maybe the economic conditions are bad and boom, markets crash. And let's imagine you lose 30%. Now, I'm sure that's happened to you in the past. In fact, it has for most people. But let's pretend that's the case. Now, here's what happens all the time. People think, because we have these conversations, people think, oh, okay, well, I'm down 30. I've been averaging about 6% a year, so man, that's going to take me 5 years to get back to even, right? I mean, 30 divided by 6% a year, that's 5 years to get back to even. And hey, good news. Yes, your math is correct. 30 divided by 6 is 5. Good job. Yeah, that's correct. But here's the problem. What you've determined, the results, are wrong. They're not correct. Now, here's what I mean. Okay, here's what I want you to think about. Let's say you start with, say, $100,000. We'll use a round number to make it nice and even. $100,000, and you had a year where you lose 30%. Your $100,000 is now down to $70,000. And now we're going to average 6% a year going forward. Let's see if indeed you'll be back to even in 5 years like your math tells you should. So here we go. You ready? And I've got my handy dandy sheet here with me to help me follow along, but here's how it works. You have $70,000. Now, year one of the recovery period, you make 6%. Well, 6% of $70,000 is what? $4,200. So you are, at the end of that first year recovery, $74,200. All right, year two comes along, you're in 6% again. And 6% of $7,400, well, by the end of the year, you get up to about $78,650 and some change. In other words, hey, after 2 years, you're getting close to $80,000. Hey, you're making some headway. Well, what happens the third year? You earn 6% again. Now you're up to, let's see what the number is, $83,371. 3 years in, you're at $83,000. Okay, it's year four. Add another 6%. Where are we now? What is it here? 1, 2, 3, 4, $88,374. Almost to $90,000. And then you get to the fifth year, you're at $93,600. $1,675. Wait a minute. You're not at $100,000, you're at $93,000. What's going on here? Because I told you already earlier, your math was correct. 30 divided by 6 is 5 years. You should have broken even. You should have broke even by now. What's going on? Well, I'll tell you what's going on. When you lost 30%, you lost 30% of $100,000. When you were trying to make up that 30%, those increases were not based on 100 anymore. They were based on the 70,000 you had left. In other words, those increases were based on a smaller number. In fact, the math tells you that if you have a 30% loss, you actually need a 43% gain to get back to even. So if you do the math, 43% divided by 6% a year, that's not 5 years, is it? That's 7 years. And in fact, if you follow the math, it does indeed take you 7 years to get back to even. Now, what does this all mean to you? What it means to you is if you're averaging 6% a year, a 30% loss costs you 7 years. 7 years is what that costs you just to get back to where you were. This is why we always say, and this is why the financial industry always tells you, losses hurt you more than gains help you. You need to avoid those losses when it comes to your retirement.
Hi, my name is Larry Flynn, and I'm one of the advisors here with Centennial Wealth. Listen, if you're soon to be retired, 5-10 years out, or in retirement, there are some critical concepts that you need to understand in making your retirement vision a reality. Don't be complacent about this. There's so many things that you need to understand, and we're putting a presentation on all across northern Michigan at venues such as this so that we can get in front of you and share some of these things with you, give you some valuable information in hopes that maybe you want to hear a little bit more or go into detail. These are not high-pressured events. We just want to get in front of you, give you some good information, and if there's a chance you might want to meet with us, great. But if not, then at least you've walked away with some valuable information and a gourmet dinner at that. So listen, want to personally invite you to this. Appreciate you coming. Please answer the call on the screen. Thanks.
Welcome back to Retiring Well. I'm Mark Canfield here with Larry Flynn, and we've been talking about why buy and hold does not work in today's markets. Larry, I know we deal with this, it seems like on a daily basis, where somebody's had some portfolio, some stock, some mutual fund that they've held for years in many cases, and they've just been told over and over, just keep that one and life will be good, right?
Yep. Well, Art, obviously if markets are going to continue to cooperate and always go up, buy and hold is going to work every time, right? Mm-hmm. And if you look at the markets over a long period of time, for the most part, it's always trending upward. So this is primarily where the concept comes from. But here's the thing, 2008, it took 15 months for the market to drop half its value. Mm-hmm. Now, every month in that time, a client's getting their statement, right? Down, down. And they're calling their advisor, Joe advisor, Jane advisor, and say, hey, listen, market's, down again. What do you think I should do? And what was the mantra?
Stay at it. Keep the course, right?
Stay the course, right? The line will straighten itself out. Well, again, it took 15 months for it to drop to half its value, but it took 5 years after that to come back to where it was at. I would agree, wouldn't you not agree, that that's kind of unacceptable.
It's a lot of time value of money lost, isn't it, for 5 years?
Yep.
And there.
Yep, there was plenty of evidence that there was some we were entering into a recession, that some adjustments needed to be made. Even if they could have, maybe gone half the way down and made the adjustment in half that time, they would have recovered a lot quicker.
Mm-hmm. I think most people understand they're never going to time it perfect, right, because it's a pick. But too, I think it's interesting to look at the fact of maybe where buy and hold is different for a younger person than somebody like entering retirement and looking to pull income, right?
Oh man, it's critical. Yeah, if you're a younger taxpayer or younger investor and you've got a lot of time on your hands, obviously, you can weather the storm because you don't need that money for income yet, right? So that person would be much more able to do what's called a buy and hold. But somebody close to retirement or in retirement, and they're now relying on this portfolio for income, and it now drops to half its value, devastating. We've always used this, what they call the 4 or 5% rule, right? This, what they called a safe withdrawal rate, an amount by which you should be able to pull from that portfolio and modestly maintain principal and maybe grow it a little bit over time, right? Well, what if I'm taking that 5% and now the account drops to half its value? If I still needed that 5% as income, now what am I taking out? 10%. How do I get that back? It's going to take a much longer period of time than 5 years to get that back.
Right, right. And thing that kind of plays into this, I know you and I have talked about this before, but kind of this theory of like the new normal. Back was it like the 80s and 90s where you could throw a dart at any investment and probably double your money every few years, right? But what have we had today? We've had a lot of this volatility, both some very good times, but unfortunately some bad times as well, and probably all the more with kind of this buy and hold, right?
Well, if you even go back to 2000, where you'd have a 50% portfolio, 50% stocks, 50% bonds. Well, the bonds were paying 6-7%. So, that worked. Today, what are they paying? We're getting 1-2%. So now you have this side making 1-2%, and then you got this side dropping to half its value. How do you make that work?
Right. Yeah, the balanced portfolio is no longer kind of what it used to be, right?
That's right.
Wow.
That's right.
So, for other people out there, what can you do, right? That we're here saying today that doesn't work. Fixed income isn't paying what it used to. Volatility in the market is probably always going to be there for all practical purposes. Some years more than others. But I guess for our listeners out there today, what can they do?
What they want to make sure they do not do, first of all, is find themselves caught in what you call passive investments. Investments that may have management with the underlying securities they're holding, but are just passively invested holding those assets. Because you got to understand, there might be management of the buying and selling. Let's say you have a stock fund, right? There's buying and selling going on in the stocks, but who's sitting back saying, hey, we're entering a market recession, maybe we should be getting out, right? What you want is active management. Somebody at the helm saying, hey, we're entering danger zone here, let's make a change.
Gotcha. Seems to make sense to me. Well, if that's you out there and you're maybe nearing or in retirement, give us a call. We'd love to talk to you and help you set up a plan that would be successful for your retirement years to come.